Welcome and thank you for joining today's webinar, Retire in Style. We will discuss how to retire in style without negative effects on your cash flow.
We're going to have the little bit of logistics for this webinar. We're going to be on the air probably for 30 to 45 minutes. We're going to have some questions and answers at the end, but during the webinar you can type your questions on your control panel to the right. And also there's no need to take notes if you don't want to, because we will supply a recording for this webinar so you can watch it again. So first of all, who are we? Jerry, why don't you talk a little bit about your background?
Sure. Well, thank you again for attending the webinar. I'm Jerry Garner. I've been in the mortgage business for 21 years. I've been a reverse mortgage expert, specializing in reverse mortgages for the past 12 years. I've been fortunate to assist over 1,500 families with the reverse mortgage, and I look forward to helping answer some questions this morning.
Fantastic, thank you. And my name is Alan Donald. I'm a realtor here at Keller Williams Realty in Charleston, South Carolina. Have more than 16 years experience in real estate, close over 300 transactions. And I'm very experienced with people moving from other places to Charleston to retire. So who are we talking to? I mean, who is our target audience today, Jerry?
Well, you know, just taking a step back for a second, several years ago, Alan, you and I had a couple of transactions together, and we were discussing different options about purchasing homes, and we realized there's a lot of misconceptions and there's a void out there in the market about using reverse mortgages to purchase. So today we're talking to those that are retired. Maybe they're planning to be retired. And if you think about the webinar title, Retire in Style, style meaning, do you feel comfortable in your home? Do you like the way it looks? Do you like the way it feels? So if you're looking to retire or planning for retirement and you're thinking about purchasing a new home, that's who we're talking to, Alan.
So a few of the topics that we will discuss today is we're going to talk about what is a reverse mortgage, who qualifies for a reverse mortgage, and how to purchase a home with no monthly mortgage payments. Or how to increase your cash flow by purchasing a home with a reverse mortgage, right?
One thing I want to focus on there is that last bullet point, cash flow. What we're really talking about here, in addition to purchasing a home, is when you're retired, you're on fixed incomes. And so how can I afford to purchase that ideal home for retirement and not have a negative impact on my fixed income? And that's the beauty of this program. It's really more than just a mortgage. It's about cash flow planning in retirement and living comfortably.
Right, right. So some of the topics that we will cover is what is a reverse mortgage, who qualifies for it. We're going to compare what the traditional reverse mortgage is used for and the reverse purchase. We're going to show you a few alternative options for financing, and we're going to clarify some of the myths of reverse mortgages, work over some examples, answer some common questions. And at the end, we're going to open up for a question and answer from the audience. And finally, after the webinar, we'll provide some links for more information. So Jerry, what is a reverse mortgage? Tell us about it.
A reverse mortgage is a government loan for homeowners age 62 or above that does not require a monthly payment.
Okay. And what is this about non-recourse? What does that mean?
Non-recourse means that the homeowner can never be responsible for owing more than the value of the home. So non-recourse means you cannot get upside down in the property.
Okay. And what are the tax advantages of a reverse?
Well, with regular mortgages, you make your monthly payment. Part of that payment's interest, and you're able to deduct the interest from your taxes. With the reverse mortgages, you have the flexibility of making payments, or as we've discussed, there are no payments required. So you have the ability to control your taxes.
Right, right, okay. Well, who qualifies for a reverse mortgage, Jerry?
To qualify for a reverse mortgage, you must be age 62 or better. The property must be your primary residence. You need to have sufficient equity or cash to put down. Income and credit are not used as qualifiers.
Okay, so I could have a sort of a so-so credit score maybe because I had some medical bills to take care of, but I can still qualify for a reverse?
That's correct. The previous question about who are we talking with, if you've tried to qualify for a mortgage in the past and maybe you were denied because of income requirements or credit score requirements, to qualify for the reverse mortgage, we do not use your income to qualify you, and we do not use a credit score. But Alan, I want to make it clear that we do pull credit, and what we're looking for is if you are delinquent on federal tax liens, that could be a problem for us. But as for credit scoring, that does not come into play.
Okay, so basically you could qualify if you don't have any delinquencies or judgments against you for tax reasons?
That's correct. Yes, sir.
Okay, wonderful. And what is this equity or cash down payment? What does it mean?
Equity, if you are going to use a reverse mortgage to cash out, you need approximately 50% or better equity in your home. So by way of example, Alan, if you have a house today you think it's worth $200,000, you need to owe $100,000 or less. If you've already sold your home and you're looking to buy a house, you need to have approximately 50% cash down. So let's say you're buying a $300,000 home, you need $150,000 cash in hand.
Right, okay. So we've heard a lot about the traditional reverse mortgage, right? Where people own their home either outright or they owe very little, and they get a traditional reverse to help them out in their monthly expenses. So basically they're staying in their home, but they just want a little additional income. That's a traditional use of the reverse, right?
That's correct. It's interesting because I was just meeting with a client yesterday, and she was applying for the reverse to purchase a home, and I could see a question in her face, and she had always heard about the reverse mortgage. They've been around since 1988, Alan. Many people think they just came out, but they've been around through the Federal Housing Authority for 25 years. The traditional reverse mortgage is for homeowners that want to stay in their home and they want to convert the equity into tax-free funds to spend as they wish. The reverse for purchase are those that are looking to possibly buy up, downsize, maybe move laterally to a location that's more ideal for retirement. So the traditional reverse mortgage is for those that want to stay in their home, and yes, you now can use a reverse mortgage to buy a new house and again have no monthly payments to worry about.
That is a very good alternative. So how does it work in terms of the equity? Just walk us through this graph.
Let's start with the traditional mortgage. For those participating today, if you look at the graph, the brownish color, a traditional mortgage means you went to your bank, your credit union, your lender, and you borrowed $250,000. There's a monthly payment, and you're going to make those payments over a 15 to 30-year period. And as you can see in that brownish line, your balance, what you owe the bank, is going to go down over time. Now, the red line is the reverse mortgage. The reverse mortgage, you borrow a $150,000 reverse mortgage, and you have no payments to make. There's no term on reverse mortgages. Whether you live in a house for 10 years or you live to be 110, you have no payments to make, but the bank is still charging interest, so that balance is going to be going up. So that's the red line as it goes up. That's the difference between a regular mortgage and a reverse mortgage.
Okay, wonderful. Now, if you do want to buy a second home, if you want to move closer to your grandkids, if you want to buy an investment property to increase your cash flow, what are the alternatives?
Well, the alternatives. What options do I have, Alan? What can I do here? Well, these are your alternatives. You can take out a traditional mortgage, a regular mortgage. Now, when you're looking at that option, obviously you must qualify. So the bank, the lender, is going to approve you based on your credit, based on your income, and show that you have made payments in the past and you have the financial stability to make a monthly mortgage payment pretty much for the rest of your life. That's a traditional mortgage. There's also what's called lines of credit, or HELOC, home equity lines of credit. They also have typical underwriting guidelines that you must qualify for the loan, and again, there's a payment required. Some may have the ability to take money out of their savings, their retirement savings, and pay cash for a house. If that's the alternative you're looking at, you want to have a conversation with your financial advisor in regards to, if I pay cash for this house, what is that going to leave me in the form of retirement savings, and can I make sure I don't outlive that money? Obviously, you can do nothing, or as we're trying to show you this morning, you can use the reverse mortgage to purchase a house and not have a negative effect on your cash flow in retirement.
Okay. Well, we don't know what the age of our audience is, so just as for the sake of an exercise, let's do a quick poll and see what the age of our audience is. All right. So I'm going to launch a poll, and then just answer it, and we'll show the results. Let's see. So now the poll is open. Just select an option of what your age is, and we'll see the profile of our audience today.
This technology is exciting, Alan.
All right, we give a few moments more. Anyone else? Okay, we're going to close the poll. Here's the result. So 67% are younger. That's surprising, Jerry. I thought that we were talking to older people.
This is very interesting. I would say, I would have guessed probably half, because half of the people that are inquiring, that are calling me daily, it's the adult children of the retirees that are inquiring for their parents about using the reverse mortgage to buy a house to move them closer to maybe the grandkids. And also, Alan, what's called the trusted advisors. We may have other real estate professionals on the webinar this morning, financial planners, accountants, attorneys. So that's interesting. Thank you for participating.
Okay, so in the reverse mortgage arena, there's a lot of myths and misunderstandings, and we're going to talk a little bit about those. Jerry, let me see if I can move forward. Let's talk about these myths. The first thing is that people think, oh, I get a reverse, then the bank owns my home. Is that correct?
That is not correct. That is false. When you take out a reverse mortgage, the deed, the title of the property stays in the homeowner's name. You maintain ownership and control of it. You could go down to your courthouse and pull your deed after the reverse mortgage closes and see that the property is in your name. So that's false. The bank does not take title to your home.
Okay, wonderful. The second question, and this one is that it's very, very often asked, is this is very expensive. And maybe give us a little bit of history with that, Jerry.
Well, the reverse mortgage is a government loan that was created back in 1988. The traditional reverse mortgage, all reverse mortgages have a mortgage insurance premium built into the closing cost. This mortgage insurance premium, this insurance is how we make all these guarantees, Alan. So when you're thinking about you're maintaining ownership of the house, you're not having any payments to make, you can never be responsible for getting upside down in the transaction. It's because of this mortgage insurance. The standard reverse mortgage, the mortgage insurance cost or premium is 2% of the appraised amount up to a value of $625,000. That's 2% of the appraised amount up to a value of $625,000. That was an additional cost that was paid, not from the customer's pocket, but built into the closing costs that are financed in the loan. Over the last few years, because of the baby boomer generation and the large number of people retiring, we now have what's called the Saver Reverse Mortgage Program. It has all the bells and whistles of the standard reverse mortgage. The one difference is the upfront mortgage insurance premium is 0.01 compared to 2%. So just give you an example. If you're participating today and you're thinking your house is worth, say, $200,000, the standard reverse mortgage insurance is going to cost you $4,000. The new Saver insurance is going to cost you $20.
Well, that's a huge difference.
And one thing that comes with that is the Saver program has a reduction of what's available by about 10%. So at the end of this webinar, you can reach out to Alan and I, and we can run some custom numbers for you to answer that question, how much can I get?
Okay, wonderful. The other myth is that, you get a reverse mortgage and then your heirs will get nothing at the end.
To be honest, that could happen. And what I mean by that is when you take out a reverse mortgage, yes, you maintain ownership and control of the house. There's no term on these transactions. So, Alan, when we talk to clients about using a reverse mortgage, we go in worst case scenario. So let's just assume you're going to live to be 100 years of age or older. You're never going to make a payment because you don't have to. And the value of your house does not go up. So you live to be 100 years of age. Your husband passes away. You stay in the house. You're protected. When both of you permanently vacate the house, say you pass away, the bank does not get the house. The house is going to go to your kids. The children, typically, there's an executor of the estate. They're going to step up, and they have up to a year to pay off the reverse mortgage. One of two things will happen. The house will be worth more than what's owed, and so they're going to get that equity out of the house, or they could be upside down, which means the house could not be worth enough to pay off the mortgage, but because of the reverse mortgage, they're not responsible for it.
Oh, so that's the main difference. They could owe more than the house is worth, but they're not responsible for that debt.
That's correct. This is a non-recourse loan. So to answer this myth, the house will go to the kids, and the kids will have up to a year to determine whether or not they can sell it or keep it based on how much equity is still in the house.
Okay, wonderful. The other myth is you get a reverse mortgage, you can't purchase a home.
That's false. You need to have either sufficient savings or you need to have at least 50% equity in the house. So you can have a mortgage on your home and still qualify for a reverse mortgage.
Okay, wonderful. But Jerry, why don't we walk through a few examples of the uses of the reverse purchase?
Sounds great.
So the first example that we're going to touch on is the cash in hand and use the reverse for buyout. What is this about, Jerry?
This is when someone has sold their home and they're looking to buy a new home, ideal for retirement. And the reverse mortgage allows you to take that money that you have in hand from the sale of the previous house and buy a new property. And we actually have an example here, Alan, that you had a client that we worked together with.
Right. So this is Mr. and Mrs. Jones, obviously not their real names. They came from Dayton, Ohio to retire in Charleston. They had sold their house up there and they had $175,000 in cash. And so they contacted me and they wanted to buy a home here in Charleston. And these were their requirements. They want a house with a master down, 1,500 to 2,200 square feet, within a 15-minute drive to the beach. That was really important to them. They wanted to be very close to the beach. And they had $175,000 down. So we started looking at what they could buy with that money.
And now real quick, just want to make sure the participants understand. They were wanting to pay cash for a house because they were retired and didn't want a payment.
Right, and they couldn't qualify for a mortgage because they were on a fixed income.
Correct.
Right. So this is one of the options that we saw, one of the best options we saw. It was built in 1965, but it was 13 miles, 22 minutes drive from the beach. And one of the cons that they saw is that the neighborhood was kind of spotty. It was the quality was not consistent. They didn't really like it too much. Here's another option they saw. This one was $169,000. It was also older, and it was way farther from the beach. They liked the fact that it was brick, but it needed renovation, and it was old. Again, they weren't too happy with it. So after looking at all the options in that price point, they weren't surprised as they didn't get the ideal home for the money they had in their hand. So I suggested, why don't you look at a reverse, and then so you can increase your price point, and I actually sent them to you.
Well, one thing that's great is all I needed on the initial contact from Alan was the age of his buyers and how much cash they had to put down. And long story short, what they did was they took their $175,000 cash. They put it as a down payment. They borrowed $175,000 from the reverse mortgage, and they purchased a home for $350,000. And they had the ability to live in this house the rest of their life using the reverse mortgage, and there's no mortgage payments for them to worry about.
So what did they buy? Let's see what they bought. They were able to get a much nicer home, fairly new. It was built in 2011. It was only 4 miles from the beach, and also only a 7-minute drive from downtown historic Charleston, with all the cultural activities happen. And they put the $175 down and borrowed $175 on the reverse, and they had no mortgage payment. So they were really happy that they could buy the ideal home with the money they brought.
And something I want to mention real quick with these clients, I remember them asking, if they could actually make payments. And so one thing we continue to say, one of the great benefits of the reverse mortgage is no monthly payments are required. You cannot fall behind on the reverse mortgage because there's no payments. However, if you choose to make payments, you can. And you can pay off the reverse mortgage at any time without penalty.
Here's another type of example. Take the equity from your existing home to purchase a second home, either to live in as a vacation home, as a retirement home, or as an investment.
Yeah, this is tailored towards retirees, those over the age of 62 that are comfortable today in their home, but they are watching the market. They are planning at some future time that they may need to downsize or move closer to grandkids, whatever the case may be. And so you actually refinance your current home. You cash out, so you take money out of your house. And you'll see here that the Smiths, they moved to Summerville, South Carolina, approximately 10 years ago. They purchased a fairly large house. They paid cash for it. They paid $420,000 cash for it, and they've been happy living in the property. A lot has happened with the real estate market over the last 10 years, and they're starting to consider downsizing. They're looking at a possible one-story home. They want to get closer to downtown and to the beaches. And so what they're able to do is take out a reverse mortgage on their current home and pay cash for a second home. Whether that second home they want to use as an investment property to create cash flow, or they just want to use it as a second home and visit with the plan in the future of making it their primary.
Jerry, we have a question from one of our attendees here. She's asking, can a reverse mortgage be taken out if there's already a mortgage on my home?
Yes, it can. That mortgage on your home will be paid off, and that payment will be eliminated. And then the rest of the proceeds you can use as you wish, i.e. purchase a house.
Okay, wonderful. So here's the situation that the Smiths were in. They had come to Charleston 10 years ago. They actually had downsized from a big home that they had up north to a 35 square foot home in Summerville, which is an area in the Charleston metro area. And they had paid cash for it. Now, what happened 10 years later?
They were able to cash out and buy a new home. As I was just saying, that the beauty of this opportunity is, and Alan, you can share more about, I guess you could call it timing the market. They were happy today in that house. 3,500 square feet. They had plenty of room for the grandkids to stay over. They really enjoyed it, but they were watching the market, and they could see that houses closer to Charleston, maybe that were constructed differently, those prices were starting to go up. So how can I buy that house without having to sell the house that I'm in today?
That's called timing the market, right?
That's it.
So they actually used a reverse to purchase, got a reverse mortgage on their Summerville home without having to sell it in a not so good market. And they took advantage of it and bought another home in a market that was rising faster to take advantage of the lower price and lower interest rates. And they are going to wait until the Summerville market comes up again, because all real estate markets are cyclical. They go up and they go down.
I just want to say this example of the Smiths, this is typically used by retirees or soon-to-be retirees that are looking to downsize, because with the reverse mortgage, you're not going to be able to take 100% of the equity out of your current home. So the amount of money that you pull out is going to allow you to buy a second home or a smaller home. And as you know, Alan, downsizing doesn't necessarily mean smaller in square footage. It could be bells and whistles, closer to the beach, closer to grandkids. So the money can be used for whatever retiring in style means to you.
Right, right. Also, another application is for those people moving south. They want to retire in a warmer climate. Charleston, South Carolina has been ranked one of the best places to retire in the U.S. But they might not want to sell their home in the current market. Let's look at this graph that Zillow has. And you see that some of the markets are not doing that great. So if you're in New York, perhaps the market is not as hot as it should be to sell your home in, but you can get a reverse, buy here in the Charleston area, and then wait until the market in New York is better to sell your home and maximize your profit.
That is correct.
Also, we're gonna we have you get a lot of questions that are repeated, right? Some of those will come over and over and over. Let's try to answer a few of these, and then we'll open it up to questions from our audience.
And I would say on this this piece here kind of touches on the idea of this webinar. I am a reverse mortgage specialist. I wake up every day trying to educate those age 62 or better or their trusted advisors on how to use the equity in their homes to retire in style, to possibly avoid outliving their savings. And the questions that I get are fairly common, and we're going to go through the most common questions and answer them.
Okay. The first question that always comes up is, how much can I borrow?
This is number one. How much can you borrow? If you look at this table there, you'll notice let's look at the $100,000 home value. If you go from left to right, a 62-year-old minimum age with a 4.5% interest rate, they can borrow $56,000 on a $100,000 home. Now that same 62-year-old, if you were to wait and let's assume that rates go up, if the rates go up to 5.5, you can only borrow 52, and at 6.5, the amount you can borrow goes down to $44,000. So what I'd like to share here, as you can see, the higher the interest rate, the less money you can borrow. But the older you are, the more money you can borrow. What's interesting here is you go down to the bottom of the screen here, Alan. Look at a $400,000 valued home. A 90-year-old at a current rate of 4.5, they can borrow $305,000. That means for $95,000, a $95,000 cash down payment, they can purchase a $400,000 home and have no payments.
Wow, that's a big loan to value.
It's more than just a mortgage. This is cash flow planning. It's estate planning. That's what excites me about the opportunity to show you this graph here.
Now, a lot of people are thinking, let's wait until values go up a little bit on my existing home. Is that a wise course of action?
Well, we're talking about timing the market, and it's not just the value of your home, but one of the three legs here on this stool. You have your age, you have the value of the home, and you have interest rates. Most people in today's economic world are assuming, and we can see that interest rates have been rising, and they may continue to rise. So if you're sitting on the fence and you're waiting for your home to go up in value, and you can see the older you are, the more money you can borrow, one thing that you have to be aware of, if that interest rate goes up, is going to have a negative impact on what you can borrow. So I think it's just a matter of reaching out to Alan and I, telling us what you're thinking, what you're trying to accomplish. Let us prepare a custom loan proposal. Let us show you what your house is worth, and then we can see if we can make these numbers work for you so you can retire in style in a house of your dreams.
Okay, that sounds wonderful. Now, what about if we're married and we get a reverse and my spouse dies?
Well, we require that all borrowers of the reverse mortgage be age 62 or above. So if you're participating, you're listening to us today, if one of you are age 62 or above and your spouse is not yet 62, then you're not going to qualify today. So assuming both of you are age 62 or better and you take out a reverse mortgage, again, there's no term on these transactions, so if you live to be older than 100, congratulations. But during your lifetime in your home, when one of you passes away, the survivor stays in the house. You're not forced to make a payment. You're not forced to move. You can stay in the house the rest of your life. So if one of you passes away, the other gets to stay in the house and benefit from the reverse mortgage.
That is very good. Now, going back to the question of, can I owe more than the value of the home? What happens?
Yes, you can owe more than the value of your home. If you recall that graph a few slides back, you saw that a reverse mortgage, the balance goes up. If you live longer than you ever imagined, you never make a payment, the value of your home does not increase, you can owe more than the value of your home. But because it's a reverse mortgage that's insured by the Federal Housing Authority, you, the homeowner, nor your children are responsible for the upside down aspect of a reverse mortgage. You can never owe more than the value of your home, but the reverse mortgage is there to protect you.
Okay, that's great. Now, Am I going to have to start making payments at some point?
No, you're never going to be asked to make a payment. The responsibilities of the homeowner are to keep your property taxes and your homeowner's insurance paid. As long as you keep your property taxes and homeowner's insurance paid, you will live in that house and you'll never be asked to make a mortgage payment.
Okay, well, what about if I need to go into assisted living and I need to sell my home?
You can sell the house at any time. In fact, you can choose to make payments. There's a lot of flexibility when you're talking about using a reverse mortgage to age in place to find your ideal retirement home. We've discussed and we've mentioned many times that you'll never be asked to make a payment. You'll have no payments to make. But if you want to make payments, you can choose to, and you can pay off the reverse mortgage at any time. So, Alan, I've had clients that take out a reverse mortgage, say in 2013, and they're thinking that in a couple of years, if I need to sell this house and move, can I? Yes, you can sell the house and pay it off without penalty at any time.
Okay. Well, all this sounds very interesting, Jerry, but, there's always a catch. What is the catch with reverses?
The catch is the equity that's in your house today. You are not going to be making payments. So the catch is, assume you're going to live a long time. You're never going to make a payment. So your children are not going to inherit as much equity out of this house. If you recall, or if you have a current mortgage on your home, you're making payments each month and you're building up equity. You're paying your balance down. With a reverse mortgage, you have no payments, so the balance is going up. So the kids, we don't know how long you're going to live, and we don't know how much equity is going to be left to the kids. But because of the reverse mortgage and the non-recourse feature, you nor your kids can ever owe a penny more than what the house will sell for. They're non-recourse loans.
Okay, well, that's the catch. There's always a catch, right?
There's always a catch.
All right, well, now we are going to answer any questions that our audience might have. I have a few questions here that we might want to answer. Let's see.
I want to real quickly talk about the process. There is a consumer safeguard feature built into reverse mortgages. You can reach out to me. I can prepare a custom loan proposal, show you how much money is available, what the closing costs are, how much down payment is needed. And if you decide to move forward with a reverse mortgage, before we can take your application, you must talk to a government-approved reverse mortgage counselor, either in person or over the phone, to make sure that you understand how the program works and to answer your questions. Once you finish that third-party counseling, you will receive a certificate. That certificate allows you to apply for the reverse mortgage, and the actual closing is facilitated by a closing attorney. So there's a lot of safeguards built in to the reverse mortgage for you or your parents or your clients if you're looking for a client.
Okay, we have a question here that says, what are the upfront costs for a reverse mortgage?
With a reverse mortgage, you're going to have your standard cost. You're going to have your appraisal. That could be anywhere from $400 to $1,000. A $400 appraisal would be your standard cost, but if you're living on deep water, if you're living on one of these front beaches in a very high-end home, the appraisals are going to cost more. You're going to have a closing attorney. In the state of South Carolina, all mortgages must be closed by an attorney. If you're in a state outside of South Carolina, you may not have that attorney cost. There may be an origination fee to the bank depending on the type of loan you choose. There's a mortgage insurance. That goes to the government, and as we discussed, that can be either 2% of the appraised amount up to $625,000 value. So the mortgage insurance could be as high as $12,000, or with the new Saver program, the mortgage insurance is now 0.01, so that could be $62. If you can think about the value of your home, what you owe, if anything, all I need is the dates of birth and the estimated value of your home to prepare a custom loan summary. And the last slide today on the webinar, you'll see Alan and my links, our email addresses, and our phone numbers to get a custom loan proposal.
Okay, wonderful. Are there any other questions?
One question I see is, how long does the process take? Process takes us approximately 45 days from when you apply to when the loan closes.
Okay, all right. Now there's another question here. do I need to live in a specific state? Is it state specific?
No. The reverse mortgage is a federal program, so you can get a reverse mortgage in any of the 50 states.
Okay. What about if they live in another country?
Well, if they're using the reverse mortgage to purchase a home here in the States, then yes, you qualify. You can qualify for a reverse mortgage to buy here in the United States.
That is great. Okay. I think we have pretty much wrapped up our webinar today. If you need any more information, here are our contact numbers. If you need to know anything about retiring in the Charleston area, you can contact me at alan@alandonald.com or on my phone number 843-900-0155.
And again, thank you for participating today. You can reach me by my email address, jerry.garner@town with an E, homemortgage.com, or you can call me at 843-670-4332. Thank you again.
Well, thank you for participating, and all of you that are registered will get a link so that you can watch the recording of this webinar. And again, send us any questions that you might have. Until the next time, thank you very much.